I have made the gigantic decision to release a lot of the videos that I do in my covered calls course for free on YouTube. This is because I believe strongly that everybody should have the ability to do the covered call, and it's such a powerful income generator that I want you all to have it. There is more available on the covered call strategies course. It still is worth purchasing because there's a lot of information on there and the videos are long and there's so many examples. But if you already have a really decent education about the covered call, there's a lot you can pick up from this video series. It's going to be a 4-episode long video series. And this first one is about the fast money trade, which is my favorite cover call strategy. And it's also probably the highest earner, I would say, consistently highest earner. So we're going to get into that. But first, we're just going to go over what a covered call is for those of you that don't know, or what it requires of you. So let's do that real fact. But first, some fun facts about the covered call is that you get to choose the duration of this trade. That means you can get paid weekly, every 2 weeks, monthly, or even once a year. You can pick any expiration date that's on a Friday for like the next year out in time. There are some exclusions there. They might be missing a few weeks here and there, but in general, that's how that works. Number 2 is that you can't lose money from doing this trade itself. You can only collect money. Now, people are going to say, that is not true. It is true for the trade itself. You do have to buy 100 shares of stock to do a covered call. And while you buy the shares, they could go down in value. That's not a function of you losing money on the trade. That is a function of your stock declining in value. So you want to be sure to really pick stocks that are really solid and go up in value. That would be what you need to do in order to be successful at this trade, the covered call, over a period of time. Okay? Covered calls can limit your gains, and they can also protect against losses. So we'll discuss that. And then, of course, you need 100 shares of the same stocks or like an index fund in order to enter this trade. Okay, so that is one of the barriers as to why not everybody does it. A lot of people are like, I don't understand, like if this is such an easy breezy thing to do, why doesn't everyone do it? Well, in order to do a covered call on Amazon, if Amazon is $200 a share, you need $20,000 to purchase Amazon shares to then place a covered call. And not everyone has access to that kind of capital. But there are a lot of lower price tickers that if you have a beginner account, you can start with, okay? So you'd have to do your research there, but there are many stocks that are in that genre of prices. Okay, so again, covered calls mostly end on Friday. The ones that don't are these index funds like SPY, SPX, QQQ. They don't. They expire like every 2 days, which can make them very appealing to certain people. And it can make it seem like in a way you're making more money. I've experimented with it and I've never been able to make more money with it. It doesn't mean it's impossible. It's just, I don't know, if you guys want to save some time, I've tried it, back tested it. I didn't have any luck. I found that individual shares work better and weekly contracts work just as better as like the 2-day contracts, okay? There are 2 outcomes after you sell your contract. So a covered call is a stock options contract for 100 shares of stock. And essentially what you are doing is you are saying, I just bought or I own these 100 shares of stock. And you're saying to the buyer, I will sell you these shares of stock if the price of those shares goes above that price we agreed to in the contract on or before the expiration date. Okay, so we're gonna have an example in a minute and go into detail on that, but that's simply stated, that's what it is, okay? So there are 2 outcomes essentially. Number 1 is that the price of the stock never goes over the stock price or strike price that you took out in the contract, and we, the seller, keep our shares. That's option number 1. The second thing that can happen is that the price of the stock rises over the strike price and the buyer pays us for our shares and takes them. So he pays us the price that we agreed to. It's usually more than we paid for the stock unless we have some bad habits there, which we're still hoping to stay away from. But we would set the strike price for more than we bought the shares for. So we would get paid to place the covered call. we'd get paid some amount of capital gains, and then that money would come fresh into our brokerage account on a Monday morning, okay? For the intention of this conversation, you're probably wondering, like, why would anyone do this? What's in it for both parties, right? And I'm here to tell you that don't think like that. Don't think like that. That's wrong thinking. That's very basic thinking, and it's very like divisive in a way. And it's very like, it's just not accurate. It's not accurate to how options work. Options are very, very complicated. And when you become an advanced trader, you don't have to do this trade to be advanced, but there are traders who trade spreads in very dynamic, interesting, multi-leg way with multiple contracts, and they might buy your call for a reason that you will never understand, and they will still win while you win at the same time. Okay, so don't think of it as win-lose, whatever. But if you must, here is how this goes for the sake of this conversation. We have to assume that the buyer's intent is that they want to buy that option on that covered call from us to buy these shares at a set price because they believe the stock will move past that and they can make a profit. If you're looking at as a win-lose game, that's why they would do it. Why would you do it? You would do it because you want the premium now, or you want the premium now and a cap gain, or you want to get rid of those shares. There's a million reasons why you may do it, but I do it just for income. Okay, that's good enough for me. So to get started, before we show you kind of an example of how to do a covered call, is that we need to look at the options chain on a contract we're going to sell. And I have this sort of oldish example of Amazon here. Okay, so if you go over to Yahoo Finance, you can search your ticker, AMZN, and then you can go over to the left and there's this word called options right here in blue. Click on that. And then over here, you can pick your date. This is the current stock price, 176.44. This is an expiration date of June 21st, 2024. We're recording this now in 2025 in May, okay? Just so you know. So this information is a little bit dated, but doesn't matter. Still serves the same point. So to sell a covered call, we have to look at the calls that are available for us to sell. Now, let's just say we just bought these shares for the purpose of selling a covered call. That would mean we are buying them for $176.44. That is $17,644 we have to buy of these shares to then sell a covered call on them. Okay. Now here, let's look at the options chain. Okay. What I like to do when this comes up in Yahoo Finance is usually they'll show you the calls and the puts in two rows. I think it's confusing to look at like that. So I actually go over and select just the calls so that it says calls only here. And that's what we're looking at right here. Because normally say calls on one side and puts on the other. And I find that to be terribly confusing for beginners. So we can then put this end date, the expiration date, to any kind of Friday in the future. You'll see multiple dates that you can choose there. And I think for the sake of this conversation, I just went out 3 weeks in time. 3 weeks is sort of my favorite time period to sell. I just think the options premiums are really juicy then. And there's been a lot of benefit for me. Okay, so all of the calls are organized by strike price. And these are bold in this color here. So the strike prices that we could sell are 175, 170, 750, 180. And this is the future stock price at which we would be comfortable selling these shares. We just bought them for 176.44. So if we sold this 175 strike price, that would mean we'd be taking a loss on the shares. And I don't think we want to do that. So the one that I would want to sell here is the 177.50. That's the fast money trade. We're going to go into what the fast money trade is and how it works in just a second. But you could really choose any of these down here, and they all pay different amounts. So the middle row really kind of is like probably the price that you're going to choose to select this for, because these are all prices. The 3.83 is basically $3.83 per share. The 380 is $3.80 per share, and the 395 is $3.95 per share. Now, why is there a range? That's because there's a thing called the big bid-ask spread here. Okay, let's see if we talk about that on the next page. Yes, so The fourth, fifth, and sixth columns talk about the bid-ask spread. And basically, this is the range that buyers are willing to pay for this option. Okay, I usually go with just the price that's right in the middle. There's some people who just want to squeeze an extra few dollars out of it, and they won't go with 380 or 383. They'll go with 390, and then they'll wait for that order to get filled, and maybe it won't, and they'll have to adjust it. I'm just like, just want to get it done. So I just go with whatever price they're recommending in the middle. I haven't ever found a problem with that. Okay. And sometimes that has a hard time filling too. So I figure, boom, I just want to be done with it. So 380 per share. Okay. So how do we figure how much we're going to get paid for the whole contract? Is we take 380 times 100, since there's 100 shares. And that means that we're going to get paid $380 to sell the $177.50 stock price to somebody on the expiration date of June 21st, 2024, which is about 3 weeks away. Okay. So that is how we are doing it right there. Okay. The other thing that you're going to want to just know is that on these options chains, the blue means in the money. As far as the stock trading terminology, it means that those calls are in the money, meaning the stock price is below where the stock price currently is. Those strike prices are below where the stock price normally is right now. The ones above are called out of the money, and those are the ones that are in white. And typically speaking, this is going to be the one that you want to choose somewhere in this range. But there are so many caveats here that we have to get into. Like, you wouldn't want to sell the 180 strike if you had bought these shares for 185, unless you wanted to get rid of these shares at a loss, because that would create a loss. So you got to kind of make sure that you're doing tracking for writing down what you purchased these shares for, because it will be very important. Okay. You need to track that for sure. Okay. So we're going on to the next page. So if we're going to choose a strike price to instantly get a profit here on this Amazon call, all we have to do is, if we just bought these shares, all we have to do is sell the first call that's out of the money. And that is a fast money trade. It just is. It's like, okay, so we are making $380 for selling the just out of the money call, or as I like to phrase it, the first strike price that is up the options chain. If those get called away from us at 177.50 and we bought these at 176.24, we're like instantly making $100 in cap gains if we have to deliver on this contract. So if we have to deliver on this contract, that means that the shares are going to get taken away from us. Okay. They're going to go to the buyer. Amazing. Okay. There's a lot of people that like panic when this happens and they go, oh my God, somebody's taking my shares. And they look like they think of it like as a punishment or some sort of bad thing. And it's not a bad thing at all. Like, we are stock trading. The idea is trade money for shares and shares for money. So as long as we're making some kind of profit, like, I'm super happy, because here, if that happened, we'd get paid the $380 in premium as a payment to enter this contract. And then we would also get paid that cap gain if the shares were called away. I guess the called away or the word assigned worries people like it's some kind of bad thing. It's not a bad thing. Just like, don't think it's a bad thing. It's a good thing. Okay. These options chains are living and breathing things that change moment by moment. So like, you could come in here and look at this, especially like on a Monday morning, and see these contracts here and then come back 5 minutes later and they're gone. They're totally different. That's because the stock price is constantly moving. So if the stock price is constantly moving, then so are these options chains. Okay. So that's kind of something that people might want to know too. The other thing that's really important to understand here is that when you're getting paid this premium, this $380, it's not something that you're waiting on to get paid on. It's immediate. It's fast money. It goes in your account right away, right away. The shares, on whether you're going to keep them or whether they're going to someone else, the other trader who bought the contract, happens when the contract expires, and sometimes before then. So one thing that you need to know is that if you sell this contract and the stock goes up and over that price 2 days or a day after you buy it, for sure you can have your shares taken from you then. A lot of people are like, wait, that's bad. No, it's good, because then you get cash in your account. It's rare. It's rare that it happens, because I sold hundreds and hundreds of cover calls, and I've only had it happen dozens of times, maybe 10 times. I don't even know. Not that many. Okay. So we've kind of discussed how this whole thing works, but let's talk about the profit and loss on the two outcomes that could happen at the end of the day in this covered call. So if their Amazon shares rise over this time period, remember that we paid $176.28 for the shares, or $17,628, and we collected $380 in premium. Okay, we're going to get paid $17,750 for these shares. Okay, so we have a cap gain here of 122. Amazing, love it. So we get a 122 capital gain, we get a $380 premium, and that means we make 502 in profit. Super sweet. I love this result. I'm not mad. Okay, this is the perfect fast money trade. Okay, if Amazon shares fall, we keep our shares. So we'll pay the $17,628 for the shares. We collect the $380 in premium. And let's just say that the shares are worth $175 on the expiration date. We have a paper loss of $128 on the shares, but we collected $380 in premium. So really we have a total overall sort of paper gain right now of $252. Why do we have a paper gain? Because we haven't sold our shares. Gains and losses are only real gains and losses when you sell the shares, okay? Premiums hitting your account are real, or premiums being deducted, are real profit and losses as soon as they happen. I am not going to debate this with anybody. I am only going to say the IRS is right about it. So if you want to go off in the comments and say silly things about, no, you didn't make money, yes, you did, check in with the IRS. Don't check in with me. I'm just following their rules, okay? All right. So in this instance on option number 2, on result number 2, there's really no reason to sell our shares. Like, why would we? We would just simply sell another covered calls on the shares, sell them and sell them and sell them until we get those shares called away, and we just keep taking in gobs and gobs of premium. I love this trade. I love it. Okay, so in this series, we're going to talk about these covered call strategies. And there are 4 of them. There are 5 of them actually in my course, 5. But we're going to talk about 4 of them on this series to leave 1 for the course. That's an amazing one. But the first one is going to be this fast money covered call. I'm going to go in and give you a real life example that I placed this morning about a couple hours ago. And you can see exactly how it works in real time. I got paid real money today for it. And it's probably enough for me to go out and buy groceries. I'm going to walk you guys through how to do a fast money cover call right on the Schwab platform. So the first thing we did was I came over here and I just plugged in my ticker on the trade panel. And then I'm just going to simply go buy 100 because I need 100 shares of stock to place a covered call. Options contracts are done in 100 shares of stock. Okay, and then I can either do limit or market here. If the market was kind of going up and down like crazy and it was very volatile, I might click limit. It doesn't really matter. Things are pretty steady this morning. So that's what I'm going to do here. Okay, then Schwab takes us to this page where it confirms the order. And I really like reading this. Okay, so it just confirms everything because especially when you get into doing options trades, it's really important to read everything because sometimes it's easy to click the wrong button and we don't want to do that. If you do click the wrong button, it's usually not catastrophic. You can go back and like change your order, buy to close or sell to open again or whatever to close it out. But I like to read this. So it says buy ASTS, at market, reinvest dividends, no. Okay, so then I'm going to click place order and we will be done here. The next thing I'm going to do is I'm just going to go to this trade button and I'm going to click on the word options because that will take me right to the panel where I can trade options. If you're wondering why this is so chop-a-blocky and why I keep putting you guys on pause, it's because I don't want you to see my full account number, okay? But here it just has a partial account number. I'm willing to share that. Okay, so here's what we're gonna do. We're gonna enter the ticker, ASTS, boom, and then this panel comes up. And it goes straight to call, which is great. So the strategy goes straight to call, and that is what it usually defaults to. I don't know if that's because I place more covered calls and it defaults to puts when other people do puts more often, but I believe it defaults to calls. That's what I've usually seen. So the next thing we want to do is click sell to open, okay? And what did we buy these shares for? We bought them for over $24.50. per share. Okay. So what I would do is I would write this down in my trading journal on my Google spreadsheet. And if you guys want a link to that spreadsheet, I'm going to put it in the comments. So like the first comment on this video will be that spreadsheet. You can get it for free there. You just have to plug in your email address and it will come out to you in an email. So I'm going to do, again, the symbol is ASTS, strategy is a call, action is sell to open, because we are selling to open a covered call contract. Okay, we have one of them that represents 100 shares. And then we have to pick like an expiration date. Okay, so I could do a weekly here and I could sell this for, I just go the first call up that's above, people would call it out of the money. Okay, that's the technical term for it. Out of the money, cover call. I like to, because I speak in very like terms that are very easy for people to relate to that don't know anything about stock options. I just always say I go for the next strike price that, or the next stock price that is up the options chain, higher than what I bought the shares for. Okay, so it's higher than what I bought the shares for. So when we do this in Schwab, it sort of gives us a bid, mid, and ask. So I always just go with the mid. The mid is like the middle of the average of the bid and the ask. And the bid and the ask, just so that everybody knows, is like the difference between what the market makers or the people who are buying the options are going to pay for them. And these can change. These can fluctuate dramatically like through the day, depending on the stock price. Okay. So what I do is I kind of look around here and I go, okay, this is the end of the week call, just so everybody knows. It's Monday right now, and this would expire on Friday. This would be $92 because this represents 93 now, because that represents 93 cents per share. So you take the 93 and you multiply it by 100 and you get $93 this contract will pay me. Okay, so that's nice. That's interesting. But what I like to do here is I also like to experiment with the dates. Okay, so the next one pays me 136. Cool. All right. The next one pays me 3 weeks, 173. So I really like this 173 number because did you notice before it was 94? 94 plus 94, what is it, like 180 something? This is not too far off of that. Did you see how the second call wasn't as generous, the 2 week? So I like to play around with this. When I go out to a month, sometimes in some markets that can really be interesting. I don't find it to be interesting this year. Okay, this is getting into the nitty gritty with you guys. I was trying to make this video simple, but I really like 3 week calls. I just do. They seem to be very generous with paying. So I'm going to click on this 176, 177. It keeps changing. Like, who knows? You could also press market here and it might get you more. It might get you 178. It might get you 173. We don't know. It could get you it could get you anywhere in the middle, but I'm just going to press on the limit of 176. Then I'm going to go and review this order. I'm going to click on this button here. So above me is going to say the full account number. If you have multiple accounts, you definitely want to make sure it's in the right account, right? So that is worth reading. I also like to read here to verify that what I have programmed the technology to do, this platform to do, it's doing. So it is doing a sell to open one for one contract, ASTS 6625. That's the expiration date. So it's a 3 week call for the 25 call. So that's the $25 stock price it's going to sell me out of if the shares go above $25 by 6.6. It's a limit order, so it has to go through for 176 or above. And it's good for the day. So if this doesn't get filled today for some reason, it will cancel at the end of the day. So really, I would kind of watch this. Now, if you look at this, it seems like, oh, this contract is going up as I'm sitting here. Some people will chase $1 here, and it's just like, I don't have that kind of time, so I don't. So anyway, as soon as we click place order, this is done. And we just placed a covered call, and me explaining it to you took 5 minutes and 6 minutes or something like that. So once you get really savvy at this, you can do this in like 2 minutes per contract. It's not very time consuming at all. Okay, don't let this weird you out that I have so many options contracts in here. What you have to do after you do the covered call is you have to make sure it went through, because it may not go through for various reasons, okay? So what I do is I come in here and I verify that this went through. And it did. It's right here, this ASTS 66 2025 25 call. And basically we got, it's kind of gone up a little bit in value since then. We don't really care. What we're interested in here is the money that we got for the premium. That's the point of doing this. It'd be nice if we made this little cap gain, which would be like, I don't know, like $50 between the 174.50 we bought these shares or 174.60. I don't even remember the purchase price. Sorry. Not 140. It was between like, what was it? 26, 25, 50. I don't even remember. And the 25, whatever. But we will make like a $30 cap gain if these shares get called away. Okay. So that is interesting. If we don't get these shares called away because the stock price drops or stays the same on the expiration date, what we would do is we would sell another covered call on these shares. And you just kind of keep rinsing and repeating this. And that's basically how you do the fast money covered call. It's insanely easy. It's insanely profitable. The rate of return on it is simply fantastic. Okay, guys, so that was one of the 4 covered call strategies that I teach in my Millionaire Mentorship program. I teach all the covered call strategies for free on YouTube. I think that this is just such an amazing thing, and everyone should be able to take advantage of these trades. There's one more. There's one more in the Millionaire Mentorship program that is the most powerful. The fast money, I would say, is my favorite. The most powerful one is going to be an earnings trade. That is in the Millionaire Mentorship program. But the amazing thing about the covered call is just that anyone can do it. Anyone can do it that has a brokerage account. It doesn't take any special clearances from your broker other than to tell them that you want to sell covered calls and they will approve you for it. Okay, so that's amazing. The other thing that's interesting about the covered call, it is really the gateway into understanding advanced options theory and advanced strategies. So it's the beginning. You can do the covered call for the rest of your life and do so fantastically well that you never have to do anything else. However, there is a way to level up. It is the beginning of something that gets much better. So if you're interested in getting very good at trading stock options, and you're serious about it, and you know you want to continue, book a call with me and consider joining the Millionaire Mentorship program. Please don't book a call if you want to know more about stock options. Watch my channel for that. I want to talk with traders who want to level up. I want to hear what you're already doing. And I want to know if I can help you improve your game. If I can, you'll be accepted into the program, and you can start learning more about advanced options theories and strategies there. If you've enjoyed these videos, I promise you it only gets so much better and so much more amazing. So book a call if you're ready. If you're not ready and you still need to master the covered call, go ahead and watch these other series of videos that are going to come out about these other strategies, the riding the stock up, the buying low to sell high, and collect premium to sell out. Okay, so that's what I've got to say. Also, if you are a covered call writer or you're new to covered calls, you can certainly join the Millionaire Mentorship program now. I think it's much easier to learn these strategies when you have somebody actually bounce the ideas off of and get confirmation of your ideas in the program, which you can get on our Tuesday meetings. So I hope to see you inside. And if you don't come in, still enjoy these videos. They're very informative.